0.5% and up 0.5%. It's firmly up about 1/3%. And you got more up than down. That's the Nifty heat map coming into view as well. So you got 35 odd stocks, 34 odd stocks which are higher, the rest which are lower, at least the word go. So 22,200 plus is back on the screen, at least for now. 1,042 stocks are opening higher and about 760 stocks are opening lower. But very, this is the first minute we are talking about, and things will change as we move forward. But let's look at stocks. Sorry.
Hopefully they change for the better, Prashant, because otherwise this is a very, very muted start given the extent of the sell-off. Nifty up just about 0.5%. The mid-cap index is absolutely flat, and the bank Nifty is up just about 1/4%. So right now, this recovery in India is actually, slightly behind some of the other Asian screens as well. Anyway, let's talk about stocks. Ultratech Cement in pole position, recovery coming through over there, 3.5% higher. M&M on those absolutely phenomenal sales numbers, both on the passenger vehicle side, SUVs and farm equipment, 3.5% up on Mahindra & Mahindra. Aisha's sales very well received by the markets, about 2.5% higher over there. Then what do we have? We've got some buying on IT names like Infosys and Wipro, L&T, ICICI Bank, Bharti Airtel. These are some of the large cap heavyweights which are adding to the tally on the upside. Remember, there's very good Chinese manufacturing PMI data that's come out this morning. It's helping the likes of JSW Steel. So I don't know if it's spreading to the entire metals pack. Tata Steel is also tracking some gains for what it's worth right now. Hindalco is also higher. So metals not doing too bad either. The downside of the screen includes names like IndusInd Bank, down about 2%. Coal India is a little weak as well. And there's NTPC and ONGC, which is down. The biggest drag on the Nifty right now is Reliance. Reliance is sulking down about 0.25%, at least for the time being. So that's how it is. Stabilizing, 100-point gain. The mid-cap at the index level, Nigel, is a little quiet.
Well, that's right. Post the clarification that's come in from Ultratech, these cables and wires players, they're heaving a sigh of relief. So I think Polycab was up. You have KEI as well, that was higher. And Havells as well. I think the first take of all these names was in the green. So some green on these stocks, though, they're just up or close to around 1% or thereabouts. Volumes have been falling, which is not good news for BSE. So after the fall that we saw last week, it's down another 2.5% in today's trading session. We're talking about, February being a very, very hot month, and things are only going to get hotter from here on. Voltas, that's up 2.5%. It's seen a sharp correction from the recent peak, but that stock is fighting back in today's trading session. From the broader markets, a couple of stocks, though, that are catching your eye. Welspun Corp, that's a big move is what we're seeing. The stock is up close to around 5%. So big up move is what we're seeing. Remember, these are some of the stocks that pulled back last week. But now, in fact, on very high volumes, I'm not sure whether there's any news flow, but that one as well is up close to around 5%. The other one is Credit Access. It was all over the place last week. I recall it surged more than 10% in a single trading session. On Friday, it went home with a cut of close to around 5% thereabouts. It ended at the low point of the day. So sharp pullback is what we're seeing. Coal India, well, the numbers actually were, for February, were a little bit underwhelming. So that's why that stock is down close to around 1.5%. Remember, it rallied in the last few sessions as well. But Ultratech Cement, as we pointed out earlier today, the street likes what they had to say on the con call. The core focus is going to be cement. This is a one-off diversification where they're looking at a higher wallet share of the customer. So that one is driving home the gains, up close to around 3% after the 8% correction we saw in the last two sessions.
So 120 points higher, 22,250 is where we are now trading at. Just a few other names. So Adani Power is up about 3% this morning, 493 on Adani Power. TVS Motor is up 4%. These are some of the big volume-led gains. Reddington is up about 3%. There is Welspun Corp, which is up 4% this morning. So coming up with volumes. Moil is up 3%. There is Wockhardt Pharma, which starts about 4% higher. I mean, steep fall, 1,600 type of levels, now about 1,200. Narayana Hrudayalaya, not seen too much price damage. That's up about 3.5%. I can go down the list, but volumes are completely disappearing. So they're not picked up, at least, beyond these 5-6 names that I've mentioned so far. And we've got IGIL. We have the company, the management joining us in a bit. So that's, I think, the diamond certification company. And that's the largest volume-led loser on the NSE. It's down 10% and it's got twice the amount of volume than as compared to the second largest volume-led cut. And the number 2 volume-led cut is Policy Bazaar, which is down 3% this morning. There is Patanjali, which is down 2.5%. Kim's is down 8.5%. That is at about 477. and Suvain Pharma. But again, volumes dry up pretty fast. Beyond the first 5-6 names, at least right now, volumes are looking a little low. So 130 points higher on the Nifty to begin this particular session. We have Karthik Kumar joining us, fund manager at Axis Mutual Fund. Karthik, good morning. Great to have you with us here on the program. Thank you for joining us. I mean, I think the simple question people want to know is, are we there yet? Even if the market does not recover quickly, is the bulk of the fall done? So let's start there, Karthik. What do you think?
If I were to hazard a guess, I would say we were probably there yet. We are probably there. But what's happened over the last couple of months is essentially, given the macro uncertainty, given policy uncertainty, and especially the transition in the US, essentially people and the market participants have questioned growth, which is why if you look at our own markets, growth stories have suffered the most. And especially growth stories where we've seen decent outperformance over the last year, or where, in other words, where momentum has been reasonably strong. That combination of stocks, or those baskets of stocks, have seen the most pain in relative terms. And in fact, what's kind of held up is are areas where there is deep value, or in other words, areas where there has been institutional interest has been not as high. Those areas have kind of held up well, and obviously large caps doing better than the breadth of the markets.
Okay, by the way, I'm trying to just find more positives here. A couple of other stocks on the auto radar that we've not discussed that are doing well. SML Isuzu's sales were very good as well, about 27% growth. That stock's flying away this morning, about 6% higher. Escort's Kubota, again, total sales were up about 11%. Some of the farm equipment makers have done well, 2% up on that. And of course, SML is up about 6% as well. So that's one pocket of green. By the way, the mid-cap index is already red. The bank nifty is already red. So it's really shaky ground that we seem to be on. Let's see. It's still early. That's the decline. But maybe this is one of those days where we have several waves after the kind of damage that we've seen in stock prices last week. Let's, get some more perspective. So then, Kumar, what is the sense? Let's talk about how to start buying in a market like this, where you don't know whether this is the bottom or if it's coming 1 week later or 10 days later or a month later. Apart from the obvious, and we've heard this, I think all our viewers know that I think there's a near consensus on buying large banks. Would you agree with that consensus? And beyond that, how do you start nibbling in a market where you don't know whether this is indeed the end of the tunnel?
I would agree to some extent on the banks being a bit more selective there, but I would agree there. But aside from that, one way to look at growth stories where growth is likely to be much more, there is much more growth visibility in the near term over the year or next couple of years. And if the valuations do get attractive with some of these growth stories, then I think they can be good entry points from a stock or a sector perspective.
So can you just name some of these pockets where now there is reasonable visibility on growth and valuations are also looking more sane? Some ideas?
So in terms of my own positioning, I continue to be overweight pharma and healthcare in general. I still continue to be overweight selective stories in consumer discretionary, while I continue to be underweight staples. And staples is largely a bottom-up decision rather than a top-down. And then commodities as well are sectors where I don't see much comfort there. So that's again an area where I continue to remain underweight.
All right. Hi, Karthik. Good morning and good to see you. And Karthik, this big debate about large versus small caps and mid caps. There was a lot of froth out there. Some of those stocks have pulled back a great deal. What would your allocation be right now, between the two?
Again, that comes down to the kind of schemes that we are managing. It will be different for different areas, but I largely agree with you that mid and large small caps have corrected. And in fact, even within the mid and large caps, mid and small caps, the correction has not differentiated much between whether you're looking at growth stocks or whether the stocks have growth visibility or not. So I think there are pockets that can be interesting there.
Right. Got it. Karthik, just a quick word on the IT services space, if you have a view. We saw very sharp falls last week, and it kind of caught up with the rest of the sectors. So it had fallen the least, but it's down. The index now, as of Friday's close, is up some 18% off its highs. What's the outlook there?
I'm on par or slightly higher than the markets in terms of the benchmark in terms of IT. Again, typically in markets like these where volatility is higher, rupee is kind of on the weaker side, IT tends to kind of hold up well over a reasonably longer span of period. So I'm hoping that that kind of trend comes back, and that the correction that we saw the other day was much more in keeping with what was happening globally rather than what is much more specific to our own sector.
Okay, all right. Karthik, on ground, the kind of feedback you're getting is with regard to, say, cement consumption. We had the core sector data that came in on Friday, and for January, it was up close to around 14%. We've seen in the past that maybe in the following month, it could swing by another percent. So maybe it'll be 13% or 15%. But cement demand has improved. And now you have the input costs that are cooling off as well. We know that the government, to hit their capital expenditure target, February as well as March will see the heavy lifting in terms of the capex spend. How do you approach something like that? Because that has nothing to do with regard to Trump, with regard to tariffs, with regard to China. It's a pure play on the domestic India story. So your take, how would you play this theme?
So the way I would look at it is essentially the growth numbers sequentially have been good, and some of the indicators that you've pointed out have been quite strong as well. And given the expectations of an uptick in government spend as well, I would precisely look at areas where the stocks or the sectors have been beaten down, and as I said, where growth visibility continues to be strong. I think there are pockets in there which have gotten which have corrected disproportionately higher, slightly compared to where markets have fallen. I think that presents a good opportunity as well.
Okay. Kumar, in the beaten down areas, which were the erstwhile leaders of the rally, whether it's capex, defense, railways, industrials overall, do you find reasonable growth plus valuations, that combo anywhere in any of these sectors?
I think some of the selective names in capex do present you that opportunity. That's an area worth looking into. And otherwise, even within, let's say, selective stocks in pharma have corrected a bit, and that's something else that I'd look at.
All right, we'll leave it there. Karthik, thank you very much for joining us. Good conversation, and appreciate you sort of coming on here on CNBC-TV18. I think what we'll do is we'll just look at what the market is looking like for now, and then we'll get more stuff. I mean, IGIL is, by the way, as I mentioned earlier, and the management will be with us here in our studios in a bit, at about 366. Huge volumes. I mean, as I said, I mean, number one volume, and it doesn't come up on the leaderboard in terms of volumes, but this is coming off on very, very sharp volumes at this point in time. The high, by the way, after listing, and it's a list. It's almost a 2025 listing, listed on the 20th of December 2024, and listed at what, 510, and ran up to about 650, and now close to about 350 now. So that's essentially what has happened here, and it's a sharp cut that we've seen. I guess we'll talk numbers on the outlook, etc. Now, what else, right? I mean, PB Fintech has picked up a little bit from the day's lowest point. So stocks at about 1,440. We've got Patanjali, which is down about 2.75%, 1,712. I mentioned Kim's earlier. Volumes are picking up a little bit now. Kim's is down 7%. Suven is down 6.5%, 1136 on Suven. Kirloskar Brothers is down 6.5%. Actually, last Wednesday, I think it was a Thursday, saw a big up move, and then Friday sold off and it's down today as well. Naveen Fluorine is down about 3.5%. Mankind is down about 3% right now. Aarti Pharma is down about 4.5%. And a name like Craftsman on Friday saw a big move higher. Coimbatore-based Autoank is down about 4.6, 4.7% at this stage. So there is a fair bit happening. Market breadth, the NSE advanced decline will come up on your screen. It's completely flipped. 2:1 now. Declines outnumbering advances. So this is just 15 minutes into, not even 15 minutes into market open.
Just two things I wanted to highlight before we go to our next management conversation. One is the selling in financials. It's uncanny. And it's large cap, it's mid caps, it's everywhere. The Bank Nifty is down 0.4%. Look at the cut so early on in the morning on stocks like IndusInd Bank, Axis Bank. And if you thought it's just SBI, and it's not just the large cap banks, now you look at tier 2, IOB, Central Bank of India, UCO Bank, J&K Bank, RBL Bank. Now move to NBFCs, Manappuram, or other tier 2 banks like Ujjivan Small Finance Bank. I mean, it's across the board selling in financials, NBFCs, banks, large banks, big banks, small banks, PSU, private, across the board. And the second issue for the market is the selling that we're seeing in Reliance. This cannot be ignored, obviously. Reliance is suddenly down 2% early in the morning, looking a little tricky. And the mid-cap index now, Nigel, down almost 1%.
Well, that's right. Let's shift focus then to InfoEdge. That's the stock on our radar. The hiring trends and their outlook for 2025 is something we want to discuss. To help us out with that, we have Chintan Thakkar, the whole-time director and chief financial officer at InfoEdge, who joins us on the show. Hi, sir. Good morning and good to see you, Ben. What are the trends looking like? What's the activity you're seeing on ground? And tell us, how is the recruitment space shaping up?
So if you look at InfoEdge on an overall basis, and if you really look at it past 3 quarters, it has been inching up in terms of the billing growth that it has been showing. Last year, Q4 was about 7%, then it went to 11, then it's 14, 16. So I think it's gradual recovery, we are seeing it. And that's across the board. That's whether it's in recruitment business and similarly in non-recruitment business. Both seem to be kind of, there's a broad growth, broad story, in terms of the growth that, it has been showing. So when you kind of cut the number and when you look at it from the geography standpoint, large customers, small customers, large developers, brokers, I think all businesses, we are looking at that it's a broader growth story and it's solid. So unless something externally significant happens, we would think that this quarter also should remain consistent to what we have been seeing it in the past.
Okay, all right. Let's get a number then out of you. Recruitment pre-COVID was at around 15%. Do you think for the next couple of years we can average mid-teens?
Well, past 2 quarters, it has been in mid-teens, and in fact, the non-tech sector has been kind of in higher teens, and IT is gradually inching up, So we are seeing the momentum, and we hope, and we internally we feel that we should move to higher teens, particularly for recruitment business. And if non-recruitment business, which is in higher teens, if it goes into early 20s, I think that would be a good result for us for the quarter.
Okay, so you're looking at mid to high teens. Sorry, I missed that number. So I mean, at a sustained CAGR basis, FY25 to 25 to say 27, 28. You're saying you can do 15%, or will it be less than 15% growth?
I'm just saying for the quarter, if you look at the last 2 quarters, it has been in mid-teens, and we would hope that this quarter the momentum continues and we kind of inch up towards higher teens. It's very hard for us to really predict about what will happen in next 2 years' time, because just like how volatile the stock markets are, the recruitment markets also keep on taking the clues from what's happening in the outside in the economy. And then accordingly, it keeps changing. So I think for the quarter, it seems that given that the past 2 quarters has been very consistent growth, and it's it's kind of a secular growth story. We think that this quarter also should remain consistent. We are seeing the building up in the IT hiring as well as in the non-IT hiring, and we think that should continue for some quarters to come in.
Chintan, on the IT hiring specifically, NASSCOM's numbers for FY25 did look very good. I mean, they're talking about hiring doubling, almost doubling from previous year's levels. And in our conversations, whenever we've spoken to large, IT players, including Mr. Salil Parekh, he's maintained that this AI disruption doesn't mean that less people will be hired. I mean, he was giving emphasis his own numbers. But the Naukri Jobs Peak Index, I mean, I think the readings are a little more mixed. So on the IT hiring front, what are the immediate forecasts you have as we step into the new fiscal?
Well, particularly seeing from the lens of what's happening in AI, we think that jobs at the lower end, which are like customer support and the BPO type of jobs, may see an impact of AI and AI agents. There are many AI agents coming up. So you will see some impact over there. But I agree in general that AI is going to create different types of jobs with much higher productivity, and the same people can handle much more volume. So you will see the productivity gains, and that that in fact, I would think that some of the internet and e-commerce companies have already started showing some productivity gains led by AI.
No, absolutely. Although the one common thing I've heard, Chintan, hi, morning, Prashant here, is that everybody learns how to use these tools, right? And some of them are getting scarily good. And everybody is in the phase of learning how to use them. Companies are doing it. Eventually, it'll come to a point where clients, large companies who use IT services, Indian IT services companies are going to demand those cost savings, which essentially is going to then, the pressure will come then. Maybe it's not coming now. Do you agree with that, Chintan?
Well, I would say that the productivity gain could be there on both sides. On the cost side, we are definitely seeing that there's some productivity gain. And particularly if you look at, let's say, if you look at all internet and e-commerce companies, after people cost, the second, biggest cost is the marketing cost, is the promotion cost. And we are seeing that the content creation is getting more efficient, is getting cheaper to create. The targeting of the audience is getting sharper and sharper. And as I said that, you'll see a relatively, if not in absolute numbers, relatively the cost of marketing going down for some of those internet and e-commerce companies. And we have already started seeing some trend of that. So there will be a productivity gain on the cost side. At the same time, there will be many more opportunities of the productivity gain on the top line as well. Some of the new products that will come that will enhance the top line as well. At the same time, I think a time has come when India is going to build AI in India for India type of technology development that will happen, and you will see a gradual growth on the top line as well. So probably the tech companies will adopt some of the AI things much earlier than the other companies, and you will start seeing the benefit of that on the top line as well as on the cost structure.
We'll just get to real estate in just a bit, Chintan. You must have seen what happened with Technicolor, right? Technicolor India, very unfortunate. The headlines there, some 2,000 plus employees, and it's part of the Paris-based sort of group, and they worked on. They're not exactly IT, but they worked on visual effects, and I think they worked on The Lion King, and really pioneers. And one of the things that they're blaming is AI. Maybe it's a lazy excuse, and maybe they were not badly managed. I don't know. But it's starting to impact lots of areas, isn't it, Chintan?
I don't know particularly about what has happened in this particular case, but there will always be some news items that will say that, look, some people are being laid off. There will always be some good news about saying that more and more GCCs are coming in the country. Right? I was just talking to somebody in US last evening, and I understand Meta is, for example, is going to create a much larger center in India, and so there will always be this kind of churn will happen, whether it's in inter-companies or whether also in terms of what type of roles and what type of positions are getting created. As I said, the lower end will probably see a much more pressure, customer support and BPO type of industry. At the higher end, if you look at the machine learning and the data science guys and the people who are experts in AI, I think their demand is going through the roof, and you might see a kind of a wage hike much more in some of those segments in the days to come.
Okay, all right. Quick question, Mr. Thakkar, before we let you go. The primary market has slowed down a little bit. And because of that, some of these companies' valuations have seen a bit of a contraction. Any kind of write-backs or provisions you have had to make in some of those companies that you have invested in?
No, we really don't see a real pain in some of the startup investments that we have done. I think they are all fairly funded, and they seem to be showing a reasonable amount of growth. So we really don't see anything which is exceptional for us to call it out. If there is something, obviously we'll call it out. We prefer getting the bad news first in the market, but so far we have not really seen any pain in any of the companies.
To write down, mark down any of your investments to a large extent is what you're telling us.
Yeah, there is some small ups and downs that happens with quarter to quarter, and I think that we always do it, but I really don't see anything significantly changing.
Okay, all right. What about how's the real estate market? What kind of what kind of inputs have you got? Is there any kind of slowdown out there, negative wealth effect? Is it plaguing the industry, or is it as good as it was in the past? Because out there, the losses had come down drastically for 99 acres?
Yeah, I think the real estate market seems to be steady. Maybe in the luxury segment, there could be a little bit more pressure. We have seen many launches happening in the past few quarters, in the luxury segment. But at the mid segment, and probably that's kind of more relevant for us, I think market seems to be steady. The reduction in the cash burn that we are talking about is actually the efficiency that I just talked about, because of the marketing content is getting cheaper, and we are getting more and more efficient in how we kind of market ourselves. So you can see that the marketing cost relative to the growth in the top line is kind of coming down. And the same thing we are seeing in other businesses. For example, Jeevan Sathi, we are seeing a similar kind of a trend. And that's the efficiency that I have been talking about.
All right. We'll leave it there, Chintan. Great speaking with you. Thank you for your time.
Thank you.
Appreciate it very much here on CNBC-TV18. Well, 60 points. So there is a bid, and it's not the problem for the last many days has been, well, buyers were absent, and hopefully buyers with some cash are there. And it's there. I mean, specific stocks, of course, are finding a bit of a bid, although I must say, market breadth in terms of broader markets, if anything, is only worsened. Three stocks down for every one which is higher at this point. So 22,000, just under 22,200 is where we stand. We come back and we get into conversation with, a stock which is under pressure this morning, which is IGIL, is limit down 10%. The management joins us from our studios. We'll ask them what's happening and what's the outlook going forward. Stay tuned.
Welcome back. Just a quick check on the markets before we carry on. And it is a downward drift on the Nifty. It's not looking good. After a 3% drubbing last week, I mean, the opening gains are quickly sort of settling down. And the mid-cap story, we've already told you. The mid-cap index is down 1%. Bank Nifty is weaker. Reliance is weaker. The other set of stocks to just look at very quickly would be wire and cables. Remember, Nigel was telling us when the market had opened out because of that Ultratech call, there was some relief that, okay, maybe all's not lost. But the thing is, the market's seen what happened with the paint sector. Companies say one thing and different kind of competitive dynamics can always play out in the market. So there's nothing cast in stone, so to speak, when a giant enters a new space. Though Ultratech is saying they're not going to be overtly aggressive. But anyway, for what it's worth, some of those gains have come off. Let's talk about one more stock that's under pressure today, and it's a recent listing. We're talking about the International Gemological Institute. They are, of course, into certification of diamonds, both natural diamonds and lab-grown diamonds. And we know that for IGI, their lab-grown business has really been growing because that's where the volumes are and that's how the market has been. Well, we have the management with us. So we have both Mr. Themsa Printer and Ishwar Iyer joining in. Gentlemen, thank you so much for being with us in the studios. Glad that you could make it. Obviously, the market's reeling under pressure and, there's maybe some sense of disappointment with earnings, and we'll get to that. But let's talk about the fact that the nature of your business is evolving because of the growth in lab-grown diamonds, right? Now, it's almost 60% of your business. Natural diamonds have come down to just about, I think, 20%. So it's important to understand what these changing dynamics mean for overall margins. This quarter, you've grown your margins to almost 57%. Yeah. But in general, do you earn lesser margin when you certify lab-grown diamonds versus naturals?
Okay, what happens is technically both are diamonds. One diamond is much more affordable than the natural one.
Sure.
Okay, so it's volume driven. So what is happening today is a lot more consumers are being able to afford diamonds, and diamond is an aspirational value for everyone. So we have gone into the fray by saying that we certify both diamonds and we give you the origin, which is man-made or earth-mined.
Mr. Printer, we're aware of that. And I remember we had this conversation even at the time of the IPO, because this is going to be a big volume business for you. But we're just trying to understand, in terms of margin differential, where do these two categories stand?
So obviously, natural diamonds are unique and rare and in limited numbers. So our margins on natural diamonds is far more than the lab-grown diamonds, where, I mean, the price is also low and we have to keep our certification cost depending on the economies of scale that we get from volumes. So overall, the realization from lab-grown diamonds is less than natural.
And Ishwar, come in on this, because I think that's one concern which could be playing out in the market. Overall, of course, sentiment is quite weak in mid-caps. But that's the concern. You're at 57% margin now. Now, how much is that margin differential? And will volumes make up that entire differential? Can you sustain at 57% or grow the margin from here as lab-grown's share keeps on increasing?
Okay. So let me just give you an overall perspective in terms of how the business has delivered over the last 12 months. We've surpassed the 1,000 crore milestone as a company, which is a tremendous performance given where we started 3-4 years back. Revenue is growing 23% at the consolidated level. And just to touch upon that, we had made a declaration in the RHP as well that IGI India would be purchasing the Belgium and Netherlands entity. We have completed the acquisition, and this is the first time, therefore, we are seeing the results at a consolidated level. So 17-18% on revenues. Overall, total income is up 20%. And again, my PAT growth is around 29%.
We have the numbers.
Margins,
we have the numbers.
So the margins, etc., is at 57-56% is commendable, given the nature of the industry that we are in. And just to touch upon what Temas mentioned, we have dynamics at play between natural diamonds as well as lab-grown diamonds. Lab-grown diamonds obviously compensate for the margin differential through the volume basis. So we are therefore 27-28% of volume growth also this year versus previous year. So that's the key driver for volume growth is driven by the lab-grown diamonds.
Is there a downside risk to your margin?
So there is, at the moment, we don't anticipate any downside risk because the volume growth should more than compensate for the slight differential between the two. Obviously, when we have a scale up of volume at the levels at which we are, we also have to ramp up our infrastructure in terms of basically adding more people, getting more space out there so that we are able to accommodate people sitting for grading, etc. But that is not very insignificant given the fact that our gross profit margin is around 80-85%. I don't think that should be a concern at all.
Mr. Printer, just a quick word on the need for certification itself. So this is from, again, it's a allied kind of transcript. This is Goldium International, which the company you know very well in the lab-grown space. On their conference call, right, somebody sort of pointed this out. And I'm going to just quickly read this out. He says, certification is driven by our customer requirements. As an example, in the US, when lab-grown diamond jewelry just started getting introduced, all customers, all large retailers required certification to separate the inventory, which was lab-grown, from the inventory, which was natural diamond. Today, with bulk of stalls in US crossing more than 50% of the inventory being lab-grown diamond jewelry, they find a lesser and lesser need for full certification or complete certification. That is it's a fundamental issue. I don't know if that is true or how do you see it?
But see, what is essential, and for lab growns, it is very essential to be authenticated by an independent certification body. Otherwise, it's just a piece of glass. So IGI provides that certification, that saying that this is a man-made diamond, and the other one is...
No, but what this seems to suggest is, because it was a new product, it was entering, and then you need to have that certification. But now if, say, 50-60% is lab-grown, then you don't need to certify everything. I mean, it is... the category itself is being replaced by lab-grown in some sense. So the need for certification perhaps goes down. That is what Goldiem is suggesting. So just wanted your thoughts.
So what happens is, initially we used to certify smaller diamonds in lab-growns. Today, the average weight of the lab-grown diamond is increased to 1.5, 2 carats plus. Earlier we used to certify 30 points. So what is happening is more and more larger diamonds of lab-growns, because they are also very affordable. So they are getting certified, and irrespective of whatever the price is, there is a awareness which is being created. Like if you see, 1.5% of the Earth's population used to buy diamonds, and that was all natural. Today, because of the affordability of diamonds, this percentage over the next few years
will increase.
Will increase to 5, 8, 10%.
So are you saying at the lower end, maybe certification requirements may drop off gradually? But at the top end, the larger diamonds, certification will be required.
At the lower end, what will happen is that they will be included in jewelry. So there will be a big spurt of lab-grown jewelry, which we also certify. So just as we started initially with the loose stones, today we are also concentrating on the lab-grown jewelry, and we are taking that into cognizance.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Let's get a couple of basic numbers out of the way. As you said, 1,000 crores for the year. And I think the growth you said in terms of volumes, the reports, I think, was around
27%.
What was the number? 9.3?
9.3 million
reports, right?
Yeah.
What about in the upcoming year? What kind of a revenue growth are you guiding for after hitting that 1,000 crore mark, which obviously you all are quite pleased about? What's the revenue growth you're looking at? The margin picture, give and take everything with regard to the mix. And if you could quantify the volumes, please go ahead.
Okay, so again, there is a small portion of an industry analysis that we did during the IPO process. I think the way we are seeing this market is currently the gem and jewelry business around $100 billion globally, expected to go to $140 billion over the next 5 years. The certification business in that component is around $600 million. Okay, and that is expected to go to around 1,100, 1,200. $600 million going up to $1.1, $1.2 billion over the next 5 years. The key aspect here is, the entire growth, over 20% of that growth, people are expecting it to come in from lab-grown diamonds. And just to the point that Tehmasp just mentioned, while we have been certifying stones, and which has been lab-grown stones I'm talking about, that's seen acceptance in the US market in the last couple of years. But what we are now seeing, a trend that is emerging, is a lot of jewelry certification in lab-grown diamonds, which is happening in India. So we are looking at consumers actually starting to come into the fold as far as India is concerned. While the final stone gets into the jewelry, which is finally what you and me, people like you and me buy. That acceptance started in the US, but we are seeing a massive impetus coming in that aspect for the India business now. So that is going to be one of the key growth stories for us. And again, coming to the margin standpoint, I think extremely strong business performances, etc. We will obviously continue to deliver on managing the revenues as well as the cost in a way that the margins are protected.
Okay, no, but give us a couple of numbers then, and
I think, again, as I mentioned, overall, around...
Revenue growth should be what, 20%, 25%?
We should look at some volume growth in excess of 20%.
20% volume
between
growth.
12 to 15% growth on revenues.
9.3 should be around what, around 11.5?
It should be, you can add another 20% to that.
Yeah,
and you gave a revenue growth expectation, 15%.
We should look at between 15 and 20% CAGR over the next 5 years.
Okay, I just want to understand, because you gentlemen made a very interesting point in terms of larger lab-grown diamonds still having the need for proper certification. When you talk about your total lab-grown business, in terms of a volume breakup, how much would be large stones and how much would be the smaller stones or jewelry? What would be the rough mix right now? And I'll tell you why I'm asking this then.
Bulk of the volume is in 1.5, 2 carat plus.
Okay.
Bulk of it. Okay. And there are 10 carats, 5 carats, 20 carat stones also. Okay, but the bulk of it remains in this range.
In the large.
Yeah.
To come back to the point that Prashant also raised about the need for certification, whether it's jewelry or whether it's the smaller stones, could there be competition from jewelers themselves or manufacturers? It's like, because when you have an item which is priced at say 25,000, which could be a small, piece of jewelry with lab-grown diamonds, you're competing with, luxury scarves and luxury shoes and luxury bags. And a lot of those items do not need certification. It comes with the manufacturer's own certification that, yes, this is genuine leather, etc., etc. So just, going forward in the future, could that be a risk to the lower value part of the lab-grown business, which could be jewelry or the smaller stones?
See, where jewelry is concerned, I mean, it'll be a cluster jewelry. So there are a lot of small stones and it depends on the designs. Okay, but however, there has to be some branding. Even the luxury brands, they carry a brand value.
But it's their own intrinsic.
Yeah.
It's not third-party certification, largely.
But, they have their own brand.
Sure.
Today, the jeweler as such need to authenticate that it is a lab-grown. So from that perspective, certification, independent certification is absolutely essential.
Okay.
Got that, Mr. Printer. Ishwar, thank you very much, both of you, for joining us. Make diamonds great again.
Thank you.
I absolutely.
They're always great, lab-grown or natural. As the woman on this panel, I can tell you that.
all
Diamonds will always sparkle.
I'm still part of the 98%.
We're very happy the moment that stone comes.
Of the 98%. So when you said you and me, I was saying it's not me. not yet me.
Gentlemen, thank you very much.
Thank you so much.
Thank you very much.
Thank you.
And we'll chat again.
Thanks,
soon
Ed.
again.
Thank you.
I think we got what, 60-point cut on the Nifty coming through, 22,060. We have, just a quick look at the market breadth, which is not improving at all. It's actually, if anything, it was 2:1 at the word go, 920 or so, 3:1. Now it's 4:1. 4 down for every 1 up. So this is like a slam dunk, at least for the broader market. So any hopes of recovery, etc., getting smashed and killed right at the word go. Although, you'll have to, of course, there will always be individual names here and there which are bucking the trend. So this morning it's Mahindra, which is up about 2%, Ultratech, which is up 2.5%, and Voltas, which is up about 2.6, 2.7% as well. And then you can sort of throw in a TVS Motor, Wipro, Eicher Motors, Natco. So lots of new names in the mix as well at this point in time. Elara Capital says that the failure of a bounce indicates a shift to a bear market verdict for the next 18 to 24 months. We don't like to hear that word, right? A bear. Now, to discuss this and more is in our charting trend segment, we have Biju Samuel, Executive Vice President, Quantitative and Alternative Strategy at Elara. Thank you very much, Biju, for joining us. Good morning, Prashant this side. So, put out the thesis, a bear market for 18 to 24 months, Biju. Is that the base case, according to you?
Yes, actually, we've shifted to this bear verdict since early January. And we were holding a structurally positive view on India since the COVID bottom. And the evidences started piling up, and most of them became really formidable by end of December, early Jan, to suggest that the market trend is really shifted to a long-term bear market.
Hi, Biju. Good morning and good to see you, Ben. So that 18 to 24 months, some months are already over, or are we at the start of that?
5 months. 5 months. There is no hard and fast rule.
But
right now 5 months are over. What it shows is we've seen a durable peak. We are going to see a durable downtrend with multiple legs. So it can be, I would say, another, based on some of the patterns, at least another 3 quarters of negative movement. That's very much there.
What are the levels? Lower from here. So, price action wise, say the Nifty is down, I think, what, 16%, right? From the highs.
Yes.
The small cap index on the other extreme is down 25%. This is as of Friday's close. So, how much more here?
See, right now, the base case scenario is market testing the long-term support around slightly below 20,000. That is around 19,500. That's where some structural supports come into place. So my base case is a market testing that level, but obviously it's not going to go straight away there. My sense is we generally, the beginning of a bear market, the first leg always leads to a massive selling climax. So I think that generally happens when a prominent low is taken out, which I think could be the election low, which is 21,300. A move below that creates a bit of climactic sell-off, which leads to the end of the first swing in the bear market. Already the small caps index, mid cap index, I think they're below the election lows index levels. So maybe the Nifty could be following suit soon. Right now, 21,800, there could be a short-lived support, but 23,000 to 23,300 has become a big supply zone now, where a lot of people are waiting to exit.
Oh, Biju, so if I could just, recap this to map the numbers straight in our head, what you're saying that eventually you see supports emerging only around 19,500. And that
Yes.
Intraday low on the election result day, I mean, that's nothing but a sentimental number. So you're not expecting 21,000 to hold at all, is it?
There could be temporary holding there, but as I mentioned, once a bear market trend is established, we are unlikely to see a sizable recovery till a full-scale selling climax is in place, where most of the hiding grounds, everything collapses in one wave for maybe 2-3 days into that fall. So that's what I expect to happen when maybe that 21,300 is broken. So we may go to slightly below 21 in that swing. That could be the point for a bear market rally.
Okay, all right. Biju, actually, the headline index going to 20,000 or thereabouts, that's close to 10% away from here. The bigger fear is what happens to the broader markets. They are already down more than 20%. What happens to those indices, small and mid caps?
They would definitely be extending the decline. We cannot have a situation where the Nifty is going there and they are resilient, which is unlikely. Maybe we have seen the mid and small phase, and now the top stocks also joining in this phase. It could be something like that.
Okay, so Biju, so so globally also a top is in, you believe, in the US, etc.?
None of our frameworks are suggesting a bearish trend in the global markets, especially the DM bull market is still intact. There's a high probability that the US dip that we've seen last week, it's turning around. The Friday's price action seems to be more like a turnaround. Yes.
Got it. Biju, can it happen that the US stays, and there have been, you would agree, right? The last 3 years, 4 years, there's been very strong correlation between the Nifty and the NASDAQ.
Yes.
If you look at indices around the world, the NASDAQ keeps making newer highs, and we keep plunging to newer lows. It can happen, like it's already happened for 4-5 months, but 18-24 months.
Yeah, so I think this is a specific macro break on India. In fact, we've been sharing this India's alpha break, those charts. Like if you look at Nifty relative to the emerging markets index, we broke an alpha uptrend after 4 years. We've been outperforming since early 2021. That structure is broken. So there is specifically an India macro negative here, and the US support here. I think the US market strength could help the IT in India.
Oh, okay. So just elaborate.
What is the specific macro break, Biju?
This is actually put it simply, if you take a relative chart of the Nifty, both the local Nifty as well as the USD Nifty, relative to MSCI EM index, I generally watch that relative with a 1-year average. It has been staying above that 1-year average since early 2021. And any setback in India's alpha was contained at the 1-year average. It was like a mean reversion. And since the last 1.5 months, we've decisively broken that 1-year average of India's relative. It actually puts us to a significant room on the downside in terms of further underperformance. We might underperform the EMs still significantly. I mean, the global market still significantly from here.
Okay, so the thing is now, Biju, going by everything that you're saying, we probably need to buckle up for another maybe 2,000 points down from here, if not more. So the question is, what could be relative safe havens? What could fall the most in this last leg? You mentioned IT. Now, last week, even IT didn't hold up at all because of maybe the NASDAQ was underperforming. But what should the strategy be from here on? Where should you take profits if you have any left? I mean, not many people would have profits. 1 year gains have been wiped out. But what could fall the most in this last leg? And what could be a relative safe haven?
Yeah, so IT is one place where I see, especially since middle of last year, the IT leadership has been sort of coming back. There is a potential long-term bullish structure for IT since 2020. So I think the latest setback that we were seeing in IT the last few days, last 10 days, most likely it has reached the worst case within that bullish framework. So IT should be very attractive here. Uh, I think the US strength further should be helping it, especially when the US broader markets in the US, broader pockets in the US does well. Indian IT, Nifty IT has done relatively well. So IT is definitely one. And the thing is, everything has the challenge also. The pattern is such that even IT should not stay weak till the end. I mean, where it is right now, it should not close there by the end of this month, where the quarter is ending. If the IT is closing weak or at these levels, or if the IT is not restoring from here, then there will be negative patterns there also. But I will not right now read into that. But I would look for restoration in IT. Pharma is also, I think, attractive. The main trend is strong for pharma. Uh, and these are the only two pockets, especially IT, where I find even absolute trends being positive, maybe for the next 16, 18 months. Otherwise, maybe on the downside, initially, the private banks are becoming a hiding ground, especially the last 10 days. So maybe that hiding ground may break. That's possible. I mean, its outperformance has reached a barrier. There is a chance of that weakening. Maybe the last few days of
Got
the
it.
selling climax could be characterized by
Got
a
it.
break in heavyweight banks.
Biju, 10 seconds, 10-second response to this. What would negate this view? Bear market view.
Yeah, ours is actually based a lot on uh, a lot of multiple factors rather than a particular level. For example, first sign of strength for us would be when we see accumulation signs, the market rewarding those who are accumulating. Since the last 4 months, what we are seeing is any days when accumulation happened, the next day the market is falling. So at the same time, when there is distribution, the market is rewarding them. So this first sign that we look for is when there is accumulation days, the market gives positive returns immediately. Market showing a response to oversold. Now the market is stuck at oversold without any response. For example, on Friday, 35% of the stocks in Nifty 500 are below 30 in RSI. And after that, we are
Sure.
seeing a muted response. Yeah.
Yeah. Biju, thank you very much. Those are sobering thoughts and sobering numbers, really, and something that we need to really take stock of. Thank you for joining in. As we're taking a break, the report from the screen is not good. India is underperforming in a sea of global green, where most markets have recovered, from Europe to Wall Street to Asia this morning. This is an outlier underperformance that has continued. The mid-cap damage has begun again so early in the morning. We're almost down 1.8% on the mid-cap index as well. So unfortunately, not much positive news to report from the street. We'll take a break, come back and look at some individual specific stocks. Welcome back. Let's put the spotlight on some individual stocks. PFC and REC are both in focus. We have Hormaz joining in. Hormaz, we're trying to find some newsmakers and maybe some green as well in the market. It's a tough morning. But anyway, tell us, why are you watching for these two?
Well, some positive commentary coming in and what has otherwise been an absolutely tough start to the new week as well. Both REC and PFC have been added by CLSA to their high conviction outperform list. But interestingly, both their price targets have been cut by CLSA to 525 rupees each. Now, for REC, it has been cut from 590 to 525, and from PFC, it has been cut to 540 to 525 from 540 earlier. For PFC, it believes that the existing pipeline of undisbursed loans will support double-digit growth going forward, and the ghosts of their past bad loans is almost behind them, and the outlook for future disbursals is positive for the company. Now, with the best delivery on loan growth, the return on assets, and dividend yields, and attractive valuations as well, it is what is prompting CLSA to add PFC to its list of high conviction outperform names. For REC as well, the commentary is relatively similar. Their undisbursed loans of around 55%, that is already signaling double-digit growth for the company. They have not had any slippages for nearly 3 years now, and the outlook on the new disbursals is also better, and they too have best-in-class delivery and a strong senior management track record. Interestingly, 12 analysts have coverage on both REC and PFC, and all 12 of them have a buy recommendation. For now, CLSA has added it to its high conviction outperform, a potential upside of up to 45%.
All right. Thank you very much for that, Hormaz, and we'll track what happens there as far as the REC PFC go. We'll take a quick commercial break here. We're going to come back, and on the other side, our special segment, it's the economy. Does the third quarter GDP hold good news? Lata in conversation with Sonal Verma of Nomura and Madhavi Arora of MK. Stay tuned. Conversation coming up.
India's third quarter GDP growth came in as expected at 6.2%. But what was heartwarming about the Friday data is that the previous 2 years' GDP, FY23 and FY24 have been revised sharply higher. FY23 has gone up from 7.2 to 7.6 and FY24 from 8.2 to 9.2. What is more important for us, the forecast for the current year GDP has also been revised higher, albeit slightly, by the NSO to 6.5% from 6.4 earlier. Well, the important point is we are nowhere near the sub 6%, which was announced for the second quarter GDP. Remember, it was 5.4, now up to 5.6. So, has the economy turned the corner? Can we see some GDP upgrades as we go forward? To answer these questions and more importantly to usher in the International Women's Year Week, I have with me two women economists, Sonal Verma of Nomura and Madhavi Arora of MK. I mean, they are top-rung economists anyways, but I'm just adding on the women's tag because it happens to be that kind of a week. So, ladies, thank you very much indeed for joining me. Madhavi, I'm going to start with you simply because you're sounding a little more positive than Sonal when I read your reports. That's my question to you, really. You know, aren't there in the internals something to draw positives, that there is a chance for upgrades? You know, agriculture 5.6, trade, hotels, transport 6.7%, construction 7.2. All these are employment-heavy sectors. If these are pushing up growth, isn't there a chance that we're going to get better numbers?
One has to realize the fact that, as the last 2 years have been revised up, the current year's slowdown is looking much more massive than otherwise. You know, you're looking from a 9.5% to now a growth which is more rangy around 6.5%. But that said, the sharp upgrades that you have seen in FY23 and 24 period also probably increase the probability of upward revisions in the current year data as well. As of now, we are still using the high frequency data for the current year, while FY23 and 24 have been revised using ASI and annual MCA data. So, one has to realize that when we entered FY25 first half, the second half of FY24 actually was running close to 9%. So we had a much better momentum, which probably could have spilled into FY25 early as well.
Quarter.
So there could be a possibility that we may see upgrades, but that will again happen with a lag of a year. By then, we would have moved on and probably, focus more on FY26 and 27. But that said, there could be a possibility there could be strong upgrades in FY25. That said, if we just focus on this year's data, looking at the quarterly numbers, I think there's more to worry than to be very optimistic about things as of now.
Oh, okay. So you're singing the same tune as Sonal, actually. Sonal, I want to anyway try with you. You are saying that growth recovers, but it is still cycling down. That's the word I think used, Sonal, in your report. I'm just trying to play the devil's advocate. Is it not that with employment-heavy sectors like trade and construction and agriculture doing well, that consumption can get a bump up? And then let us remember there is also the tax break that's coming. So can't consumption give you a pleasant surprise?
I think when we try to look at growth and analyze growth, we need to segregate the cyclical sectors and the non-cyclical sectors. What we've clearly seen in the third quarter is a much better momentum. And if you look at the components that have driven it, I would say to a large extent are sectors that are not as cyclical. So government spending has picked up after the election and code of conduct and heavy monsoon related slowdown. Rural demand has picked up because agriculture output is better, and some of these factors will be here with us. Now, the other side of the equation, are the more cyclical sectors that are more private sector driven. So urban consumption, which is driven more by things like availability of credit, salary increases, stock market wealth effect, private investment, which has slowed down despite the pickup in government consumption, and exports of services have picked up. But it's really been a big contraction in import, which is a signal of domestic demand that led to a big net export contribution to GDP growth in the third quarter. So I think it's in that context that Q3 has been better. but the components that are driving that, don't give the confidence yet that we are on a durable recovery path yet.
Okay. Would Q4 be better than Q3? What's your number, Sonal?
Yeah, we are looking at around 6.5%. I mean, the second advance estimate implies a 7.6% for Q4, which at this stage looks too high to us.
Okay. Yes, that's what many people told me. But Madhuri, I want to persist with that point also. The CA made some very relevant points. Maybe you can still accuse him of stretching his optimism, but nevertheless, the Mahakumbh is much bigger than anyone earlier forecast. That will mean at least one-shot GDP growth. It's not persistent, but at least a one-time. And then there is the services exports have done extremely well. And then you have, some momentum coming in from the rate cuts and liquidity boost given by the Reserve Bank. Can't we make it to 7% in Q4? Is that out of line?
So, Lata, a large part of the, Q4 GDP print is essentially coming from the surging net indirect taxes effect, which is what we saw last year as well, right? The GDP is looking much more realistic, though we think there could be a downside risk there as well. But GDP is largely driven by the difference between GDP and GVA is massive, which is largely driven by the fact that there could be an estimated net indirect taxes growth of more than 15%. January data so far also has shown that the subsidies for the center has actually been 20% lower than last year because they were largely front-loaded in this financial year. So there could be a possibility that there would be a big wedge between GDP and GVA. So we'll have to remove that noise as well. GVA is expected to grow much less dramatically to around 6.2% in the 6.8% in the fourth quarter. There could be, as I said, modest downside risk there as well because, we had seen large part of this, 4-5 months growth essentially led by government spending, which could possibly slow in the fourth quarter. But you will have the one-off effects of, Mahakumbh festival, as well as probably agriculture growth, which is also envisaged to grow above 6%. And again, that will not have a spillover effect on, following quarters. So I don't think this temporary boost to GDP should be seen as a strong, indicator to the underlying growth or a spillover effect that could be seen in the following quarters. So I think it would be unfair to assume that just because we'll see a massive growth, possibly a higher than around 7% for that matter. But I'm not sure whether that could be seen as a permanent boost to growth. It's just a temporary surge that you will see.
Okay, I don't know why you're skeptical about government spend because now we have the January capex that is 50% higher than.
I'm going by the budget estimate, so I'm just doing the
I agree. I agree.
Expenditure.
Yeah, so even, of course, to be fair, even last quarter, October, November, December, the total spend is 50% more than the previous year-ago quarter, but gross fixed capital formation is only 5.7%. So, it's a small part of the overall capex. But Sonal, exactly the same thing. Don't you expect the Reserve Bank steps, liquidity steps, and government capex really coming good now? In December, it was double what it was in year ago December. January, we have the capex numbers. It is 50% more than year ago. Can't all this give more legs to the current quarter itself? Better than 6.5%?
It's possible, Lata, but I think, the current quarter is almost over in 1 month. I think we ought to be focusing on the next 6 to 12 months. Now, just on government spending, actually, the fiscal deficit number for Jan was much higher than anticipated. So while capex is picking up, tax revenue, particularly the corporate tax revenues are quite low. So based on the revised estimate for FY25, actually, the fiscal deficit for the next 2 months ought to be much lower than what it historically has been in the last 2 months, which means that we could see some moderation in capex in the month of March. But I agree with you. I think, the counter-cyclical policy tools are underway in India. It's just that it takes time and it's coming across in the backdrop of this ramp up on trade protectionism that we are seeing. And that has led to some front loading of exports in anticipation of the tariff hike. So the payback effect will actually be seen in FY26. And I think also this on the urban consumption side is something we need to closely monitor, because while the macroprudential norms are being eased, delinquencies are also picking up in the unsecured segment. So to what extent banks would want to lend to these segments is not very clear as of now. Plus, as I mentioned, stock markets, there is a wealth effect that will be spilling back into the urban consumption side. So we have to look at overall how things play out. It's possible Q4 is much better than expected. Policy easing is happening, but in a backdrop which still looks a bit hostile to us. So it is in that backdrop. Currently, we don't see a sustainable recovery as defined by 6 to 12 months of sustained uptick in place.
And so your FY26 is only 6%, Sonal, right?
Yes, we are expecting 6% next financial year.
Okay. Madhavi, what are the chances of next year surprising on the upside? See, after all, our exports to the US is 2% of our GDP. Yeah. The actual extraction in terms of value add for us, some people are calculating is 0.1 to 0.3% of our GDP. So can the global headwind is bad, but can it be, since we are a domestic facing economy, can we still do better next year?
Lata, for that, we need to have a much more counter-cyclical policy effort, which is not being seen as of now. If you look at the Reserve Bank's balance sheet, that has grown less than 1%, while they are doing all the liquidity measures that they can in the recent months or so. One has to realize they're just paying for their past sins, because between October to December, they intervened up to $100 billion worth of FX intervention, of which the large part of liquidity suction that has happened is because of that. And this is what they are basically sterilizing. At this point in time, the balance sheet is still grown less than 1%. Reserve money is still sluggish. Credit offtake is obviously impacted because of that. So monetary conditions are still tight despite supportive measures that RBI has taken. I mean, if you look at the outstanding value of CDs at this point in time are very high. So RBI needs to sort of be much more easier on its stance. We can possibly see further cuts coming from the Reserve Bank, but we're not very sure as to how deep that would be. On the other hand, fiscal is still at this point in time is, I believe, pro-cyclical. While we have seen some support to the urban segment, urban middle class led by the tax cuts, they've clearly have been cutting the revenue expenditure, ex-interest payment subsidies, which is going to impact the rural segment, which has just started to recover. On the other hand, the urban segment, the wages have been pretty sideways and actually are low on the real basis, which is going to impact the urban consumption. Income effect would be much more felt than the wealth effect that people are talking about. I think to that extent, my absence of the private economic agents is going to be probably the story which will play out even next year as well. And that's why we believe that even though the external headwinds are something which are not in our hands, the domestic dynamics are also not very solid. And at best, you're going to be growing at around 6.5%, which is what we're probably growing in this year as well. So there's very little impulse that I am seeing in terms of growth.
Okay. Point taken. We have to come to terms perhaps with the 6.5% growth. And the big point is we should not come to terms at a policy level with 6.5. We need much more in terms of policy redesign. Those discussions on a later day. Thank you very much for joining me, Madhavi and Sonal, and ushering in our international